Have you ever wondered what a Bitcoin ETF is? Well, let's break it down. A Bitcoin exchange-traded fund, or ETF for short, is a financial product that lets you ride the Bitcoin wave without getting your feet wet. In other words, it allows investors, yes, like you and me, to gain exposure to the price movements of Bitcoin without actually having to hold the asset itself. Now, why is this important? For starters, it offers a convenient and regulated way to invest in Bitcoin. This has caught the attention of both retail and institutional investors, who see it as a safer and more accessible avenue to the cryptocurrency market. And it's not just about convenience. Bitcoin ETFs also bring regulatory compliance to the table, offering a level of oversight and protection that is often missing in the direct cryptocurrency market. But here's the thing, not all Bitcoin ETFs are created equal. Now that we know what a Bitcoin ETF is, let's delve deeper into the two main types of Bitcoin ETFs. First up, we have the spot Bitcoin ETFs. Let's dive into the world of spot Bitcoin ETFs. These exchange-traded funds hold actual Bitcoin as their underlying asset. The primary goal? To track the real-time price of Bitcoin. Now this offers a fascinating advantage. With spot Bitcoin ETFs, investors get direct exposure to Bitcoin's price. It's like holding Bitcoin, but without the hassle of managing digital wallets or dealing with blockchain technology. But why is this important? Well, it opens the door to the world of cryptocurrency for a broader range of investors. Those who might be put off by the perceived complexity or risk of buying and storing Bitcoin itself. However, it's not all smooth sailing. Spot Bitcoin ETFs face potential regulatory hurdles. While they've sparked significant interest, regulatory bodies like the U.S. Securities and Exchange Commission have yet to give them the green light. This hesitation stems from concerns over market manipulation and investor protection. But don't let this deter you. The landscape of cryptocurrency is ever evolving, and the dialogue between regulators and the crypto industry is ongoing. It's a space worth watching, as the approval of spot Bitcoin ETFs could mark a significant milestone in Bitcoin's journey towards mainstream acceptance. So, spot Bitcoin ETFs offer direct exposure to Bitcoin's price, but what about the other type of Bitcoin ETF? Now let's talk about futures Bitcoin ETFs. These are a bit different from their spot counterparts, and here's why. Instead of holding actual Bitcoin, futures Bitcoin ETFs use Bitcoin futures contracts to gain exposure to the cryptocurrency. Think of it as a way to ride the Bitcoin wave without getting your feet wet. Futures contracts are essentially agreements to buy or sell an asset, in this case Bitcoin, at a predetermined price at a specific future date. So when you invest in a futures Bitcoin ETF, you're not directly investing in Bitcoin. Instead, your investment hinges on these futures contracts. Now this approach has its perks. It can be a more convenient and regulated way to invest in Bitcoin, especially for institutional investors. It also provides a way to potentially profit from Bitcoin's price movements, without the need to deal with the complexities and security issues associated with holding the cryptocurrency itself. Yet it's not all smooth sailing. One potential drawback is the potential for higher fees. Since futures contracts are involved, there can be additional costs that you wouldn't encounter with a spot Bitcoin ETF. Plus, the indirect nature of the exposure means that the price of the ETF might not perfectly track the price of Bitcoin. In essence, futures Bitcoin ETFs offer a different approach to Bitcoin investment, using futures contracts instead of direct Bitcoin ownership. So, we've explored the two main types of Bitcoin ETFs, but what does all this mean for you as an investor? Let's start by recapping. Spot Bitcoin ETFs hold actual Bitcoin as their underlying asset, tracking the real-time price of Bitcoin. On the other hand, futures Bitcoin ETFs use Bitcoin futures contracts to gain exposure to the cryptocurrency. The key difference here is how each type of ETF exposes you to Bitcoin's price movements. Spot ETFs offer direct exposure, while futures ETFs offer indirect exposure through futures contracts. This distinction, while subtle, can have significant implications for your investment strategy and potential returns. It's also important to note that the availability and structure of Bitcoin ETFs can vary by country and region due to regulatory considerations. In the US, for example, the SEC has approved Bitcoin futures ETFs, but has yet to give the green light to spot Bitcoin ETFs. As an investor, understanding these nuances is crucial. It's not just about investing in Bitcoin, but also understanding the structure and risks of the ETF you choose. Remember, knowledge is power, especially in the world of cryptocurrency investing. Now you're armed with the ins and outs of Bitcoin ETFs.